Hi everyone, it's Cal, your triple net broker here. Happy holidays to you, and wanted to make a quick video just about the triple net basics here. As you see here, price, cap rate, NOI, net operating income. So I'm gonna go ahead and switch this to a slideshow view here. Make that like that. Okay, so this is a KFC. It's a re-image one. This looks a lot different from probably the ones that you guys saw 10, 15, or 20 years ago. And again, this is the nice thing about owning a triple net property. When the location does well, the tenant, the corporation, or the large franchisee, they want to spend money to upgrade, refresh the stores, and make them more modern, more appealing. I mean, I think this store looks great compared to the previous KFC models and store fronts out there. So real quick again, disclaimer as usual. Just the same as the last one. None of this should be considered tax, financial, or legal advice. Agenda: defining price, cap rate, net operating income, and then how to figure out the very simple math behind it. Again, triple net is meant to be straightforward, not a lot of complicated math. So price, there's still different types of prices that you see out there. There's the list price, or the price that the property is brought to market at. There's the under contract price. That's a price you typically don't get to see or hear about unless you talk to the listing agent. And the sales price, the final price that's recorded, and that the price that the seller is willing to accept once escrow closes. Net operating income, or just commonly NOI, just easier to say. It's the in your pocket income after all property expenses. And if you're buying a true absolute triple net lease, again, I think I'll make another video about the different types of triple net leases. Absolute being the passive, most passive one, where you essentially don't have to do anything, and the gross rent that you get is the NOI, the net operating income, because there's no property expenses to deduct. You don't have to deduct for taxes, for repairs, for maintenance, insurance, any of that. All those costs are taken care of by the tenant. Now, the cap rate here is, how you calculate the cap rate is basically you take the net operating income and divide it by the price, right? And that's your return before you have to factor in any loan costs or mortgage debt that you may be servicing on the property. So very simply, NOI divided by price, which you see right here. This is the formula. And here's an example. This is a Wendy's that I sold a few years back in Nashville, Tennessee, in that market. And we see over here, you have the net operating income of $146,460. Now, in this particular case, this was an absolute triple net lease. So this income here, this is the gross rent, the annual rent, the NOI, all the same, all interchangeable, because there were no expenses that the landlord incurred. Everything that required building maintenance, repairs, no management, because the tenant maintains the building themselves. That was all 100% paid for by this Wendy's franchisee. So here's the sales price. Ultimately, we started a bit higher, but still got almost the full list price for our client, the seller, $2,525,000. And so the buyer, their cap rate would be taking this $146,000 and some change, dividing it by this $2,525,000, and you get a 5.8% starting return. Now, I say starting return here because typically in these fast food leases, there's going to be rent increases, typically 10% every year or 5% every year, or sometimes even annually, right? And so that's nice because that increases your return. Your mortgage stays the same if you have a loan. You get increased cash flow, right? And that increases more money in your pocket because, again, you're not paying for any of the expenses, right? Expenses typically will increase. As you know, your property taxes typically go up every year, and so does your insurance. But here, those costs are all paid for 100% by the tenant. So your rate of return is going to increase because your expenses are not paid by you. They do increase, but the tenant takes care of all of that. So that's and again, another advantage of triple net property investing. Closing thoughts, meant to be easy. All you really need to know is to figure out the relationship between the price, the net operating income, the cap rate, deciding what kind of a cap rate of return that you want, and then going out there and seeing what kind of properties would best fit your investment criteria. Now, typically, cap rate is a measure of risk, right? The riskier the property, the higher the rate of return, and hence higher the cap rate. And so this is something you want to talk to with your broker and your family and your financial advisor to see what makes sense for you guys. I typically like to be conservative for my clients because, again, most of my clients are older, close to retirement, or already retired, and they're not trying to hit a home run. They've made their money in multifamily or even their own business, right? Triple net is really meant to be a way to preserve wealth, create a lifestyle where you're not in the day-to-day operations of a property. You spend more time doing other things, spending time with your family. And so I like to be conservative. I tell my clients, don't chase return. You have to think long term. Unless you do want to chase return, again, that's can be a part of your portfolio if that's your strategy. But again, typically the majority of my clients, they want a passive income play. They want to be able to collect a check, not have to worry about getting the calls from the tenant, and basically leave me alone and let me enjoy my life. So that's it, everyone. This one, just I put in the background, this is the same Wendy's here in Nashville that we sold. This is an area overview of the area. So when we're marketing the property, we definitely like to show what's around there because, again, location is everything. I really like this site because it's right here at a major intersection, two major travel corridors, retail corridors. Again, you in and out of the market there. And there's a Walmart here as well. So I like to look for properties that are near a large big box retailer because that drives traffic in and that ultimately drives in revenue and creates staying power for that location. So hope you guys found this helpful. Again, here's my information. If you do have any questions, feel free to shoot an email or call me. That's my direct office line right there. Or leave a comment below in the video. So hope everyone's doing well. Happy holidays and take care.